Welcome back. Let's get to our segment Midcap Spotlight, and we've got a company called Sportking on our radar. Surabhi is here to explain the news and a little bit about the company as well. Surabhi.
Thanks so much for that. So today our spotlight is Sportking. Now we don't talk about the company much, but yesterday there was a block deal where an HNI investor bought 1% stake in the company. Now in the last 6 months the stock has gained nearly 30%. What exactly Sportking does is it manufactures cotton and synthetic and blended yarn. Basically it's a yarn company, and it has manufacturing units in Punjab. They have a 3.8 lakh spindle capacity and a 20 ton per day dyeing capacity. In FY23 they added 35% of their existing capacity. 90% of their revenues comes from the yarn segment, and around 10% comes from their garment and the fabric segment. Now they cater to India and export market both. 40% of their revenues comes from the domestic market, and around 58% comes from the export market. Now when you look at their financials, they're not so bad, but because it is a yarn company, they're quite erratic because a lot depends on the cotton prices as well. So in the last 5 years, the revenue has seen a compounded growth rate of 16%. The EBITDA has seen a growth rate of 22%, and PAT has seen a growth rate of 47%. Now even when you look at their valuations, they are valued somewhere between a yarn company and a garment company. Garment company usually have higher PE, whereas yarn companies have lower PE. So they are trading at around 7 times FY24 PE, while some of the garment companies are trading like Indocount and Vardhaman Textiles are trading anywhere between 10 to 12 times FY24 PE. Now some of the risks that I want to highlight in this company is that there is no institutional interest. So 74% is held by the promoters and the rest is public shareholding. Their revenue and PAT growth has not been consistent because, as I said, 90% comes from yarn, so it's a lot dependent on the cotton prices and also the forex rates, because 60% of their revenues are exported. Also, their margins have fluctuated between a wide range, which is 10% on the lower end and 28% on a higher end over the 10-year span. So the margin is also quite varied, and they also require large working capital, which is why their free cash flows also is negative in some years and positive in some because of their working capital requirements. So there's some risks to this as well.
Okay, all right. Thank you so much for joining us with those details. Interesting take there. The stock is high by 7.5%. And thank you for highlighting some of the risks as well that the viewers should be aware of as well. With that, let's move on and speak or focus on the chemicals industry. We've been highlighting some export issues that